Hello, this is Brian Shannon from Alpha Trends Blogspot. It's Monday, the 26th of November, 2007, and what we're going to do today is take a look at a longer-term chart of the S&P 500. I wanted to take a look at this just to kind of give you an idea of where I think this market has the potential to go, and why I still think there's a lot of reason for concern when looking at the S&P from a longer-term standpoint. You can see that this market, where we're looking at right now, that is a weekly time frame, meaning each one of the candles represents 1 week. And I've got one simple moving average on here. That's the 40-week moving average. You can see that's the black line there. Now, a lot of people get nervous when the market dips below the 200-day moving average. And all throughout this bull market, I've been saying it is a reason for concern when the market dips below the 200-day moving average. It is a widely watched benchmark by many institutions, and generally people think that bulls live above the 200-day moving average while bears live below it. And there's reason for concern, like I said, when the market dips below that. However, it doesn't usually end a bull market. Just as a rise above a moving average in a downtrend doesn't end the downtrend either. It sucks in a lot of new long positions over here and a lot of shorts in here, which are good to reinforce that trend because they get squeezed as the market rallies again. And we saw it even in August over here. Reason for my concern right now, though, is the direction of the moving average is much more important than where the market is in relation to it. And you can see here that back in 2000 when the market topped out, and what we'll do is we'll back it up just a little bit further to get a little more history of the relationship of the S&P 500 on a weekly time frame to the 200-day moving average. And you can see here in the prior bull market, numerous tests and a few dips below that 200-day moving average as well. And that wasn't really more than just a correction, any of those dips below it, until we had that moving average start to flatten out, and the market then rallied up to and found resistance at the 200-day moving average right in here late in 2000. When it then confirmed the downtrend by making a lower high and then a lower low, then it was a multiple year bear market that really hurt a lot of accounts out there. So it's more the direction of the moving average than where it is in relation to it. Although when it's below the declining moving average, you generally want to be bearish on the market. When it's above an advancing moving average, you generally want to be bullish. So there's been good reason to be bullish throughout here, and these are just areas for caution. Now, though, it looks like this market, again, we have this 40-week moving average, which is starting to flatten out. And that tells me that the longer-term forces are starting to kind of neutralize, and that means it could potentially, and the key word here is potentially, be putting in a longer-term top. When you take into consideration some of the other technical factors here, I think there's a lot of reason for concern. Now, when you look at this pullback, since the high 7 weeks ago, we've seen this market drop about 17 points, or about a little less than 10%, or a little more than 10% rather. Now, typically, when you go back, these declines seem to be halted at or near about a 7-week decline. So that's one reason to think that maybe the selling is getting a little bit overdone. However, on a percentage basis, we could still see further decline. It's not, you don't ever want to look at the market and say, well, it found support after 7 weeks 5 out of 6 times in the past. That's a reason to look at the market and think maybe it's time to switch down to shorter term time frames and look for evidence of neutralization of this downward momentum. However, obviously, when you look at the daily picture of the S&P 500, there is no such evidence. So that brings us to what could potentially be brewing for this market here. Now, I think there's some people that are probably looking at a trend line that looks like this, which would give us some potential for a turn near the 140 level. Now, that's one potential area. I don't think that that's really the most valid trend line here. The way you want to draw a trend line is the more times it touches, the more valid it is. And I think that the more valid trend line is probably right here, which brings the market down towards about the 2006 highs, which were approximately 133.5. So that's not an exact measurement. I think it was 133.80, but approximately 133.5. is where that would basically bring this market down. You can see that it also would be a potential level where there might be buyers or a lack of supply, because it's also the location of this rising trend line that touches right over in here numerous times as it dipped below that 200-day moving average. That's where those trend line, the trend touched upon that several times on that trend line. So there's reason to think that maybe that's where this market could be headed. Now, if you take a look at some more technical evidence, what we can do is just clear this up a little bit. The high here was 157.50. Let's be conservative and call the lows, and this is where there's been important support, which has acted as resistance too recently, is 145. So the height of this is about 12.5 points. This is looking a lot like a true double top. Now, all the way up in a bull market, there's been all kinds of calls for this being a double top, that being a double top. Everything's a double top, but the real double top is when the market makes a high in about the same location. You call this point A right here. This would be, the pullback would be point B, which brings us to 145, and then the next rally would be point C. What we do is we take the height of that and measure it, and it's basically 12.5 points. We then subtract that 12.5 points from the breakdown point, which is 145, and that will give us a target down at about 132.5. So that would bring the market to about right here, which again is very close to the 2006 highs, and a lot of times resistance becomes support on a test, and also the location of this trend line. Now, I don't think this market is going to crash down to that level. Basically, that's about 8 points away and would represent a very significant decline here. Although there's still no technical evidence that this market is losing any of its downward momentum when you look at the daily time frame. It just seems as though this market is getting closer to an area where it could potentially bounce. It doesn't mean you should be buying. It doesn't mean you should not sell short when the time is right on the shorter term time frames, okay? Because we're looking at a 30-minute time frame now, and you can see that there's still a very solid downtrend intact. So let's stay focused on this bigger picture here. If this market really is going to top out, I think it will do it in a similar way to what we saw here, where the market broke below that 40-week moving average. It then rallied for about 2 or 3 weeks, and this was a pretty big rally if you look at it. From this low here at about 130.16 up to about 2-3 weeks later to 144. That was a 14-point move, or about 10% in the course of a couple weeks. A lot of people start thinking, hey, that's the end of the decline. But if we get a rally up towards that 145 level, or where this moving average is right now is about 148, if the market rallies up there and then finds resistance, I think that this market could be in a lot bigger trouble and probably head down towards this trend line, which is also giving us a potential level of support based on this prior high and the approximate measured move down from the double top. So there's still a lot of reason for concern. This market gets more sold out each day, so it may turn in here at some point, maybe after a little bit more selling to the upside. But keep an eye on that 40-week moving average if we do get a bounce up towards there. If that acts as resistance, then I think you could see maybe the beginnings of a multi-year decline in the market. I don't mean to alarm anyone, just looking objectively at what the market is telling us here.